Manage risk with stop-loss orders. Managing risk is a fundamental aspect of trading, and stop-loss orders are a key tool in achieving this. A stop-loss order is an instruction to exit a trade at a specified price level, and it plays a crucial role in protecting your trading capital. Here's a broader explanation. In trading, there's always a degree of uncertainty, and not every trade will be a winner. Stop-loss orders are a risk management mechanism that helps you limit potential losses. When you enter a trade, you set a stop-loss order at a price level where you're willing to exit if the market moves against your position. For example, if you buy a stock at Rs 50, you might set a stop-loss order at Rs 48. This means that if the stock's price drops to Rs 48, your position will be automatically closed, limiting your loss to Rs 2 per share. The primary purpose of a stop-loss order is to prevent large and uncontrollable losses. It acts as a safety net, ensuring that if a trade goes south, you'll exit with a manageable loss rather than letting the losses mount. This is crucial because large losses can significantly erode your trading capital and make it difficult to recover. Stop-loss orders also free you from the need to constantly monitor the markets. Once you've set your stop-loss levels, you can let the trade run its course without emotional interference. It's a tool that enforces discipline and risk management in your trading. However, it's important to set stop-loss levels thoughtfully. They should be determined based on your trading strategy and risk tolerance. Setting them too tight can result in premature exits, while setting them too wide can expose you to larger losses. In summary, using stop-loss orders is a critical aspect of responsible trading. They help you manage risk, protect your trading capital, and ensure that you stick to your trading plan by automatically enforcing exit points.